response during the presentation. I now invite Dr. Kaur to say a few words. Dr. Kaur, please.
Thank you, Karen. Good afternoon, and thank you all for joining us over lunch. Today, we are also holding our second AMRO forum to tackle the economic and financial challenges faced by the ASEAN+3 region. And we are pleased to launch our second flagship report on this occasion. Over the last 2 years, the global financial landscape has shifted from a state of low for long interest rates with ample liquidity to one characterized by higher for longer interest rate with receding liquidity. This new environment has the potential to worsen hidden or less visible financial vulnerabilities and trigger a financial crisis. In view of the riskier environment, AMRO has enhanced our surveillance of the financial systems in the region. The ASEAN+3 Financial Stability Report, or the AFSR, is AMRO's pioneering and second flagship report. Tailored to ASEAN+3 economies, the report dwells into recent financial market developments and potential risks in the region, and provides an in-depth analysis of the high impact of high debt on financial stability. Since early 2022, following the outbreak of the Ukraine crisis, global central banks led by the Fed have responded to the escalation in headline inflation by rapidly tightening monetary policy. This has led to spikes in risk aversion, market sell-off, capital outflows, and large currency depreciation in emerging markets. Against this backdrop, Chapter 1 of the report discusses recent market developments and notes the risks facing ASEAN+3 economies within a constantly evolving financial landscape. The phasing out of COVID-19 financial reliefs and regulatory forbearance policies in a higher interest rate environment has led to concerns over the risk of financial distress and insolvencies, particularly in the context of the much higher level of debt stock in the region. In chapters 2 to 4 of the report, we focus more on in-depth analysis of such risks facing the region. For this inaugural issue, we have chosen the theme of navigating high debt in low visibility to assess the financial stability risk from higher debt in the region in a more uncertain environment. Today, the internal and external macro financial conditions surrounding the ASEAN+3 region are subject to high uncertainty and volatility. The region must come together and strive for economic and financial resilience and stability. AMRO holds high hopes that our ASEAN+3 Financial Stability Report will serve a pivotal role in our collective efforts and make a substantial contribution towards achieving this objective. I will stop here. Thank you.
Thank you, Dr. Kaur, for explaining the purpose of our new report. Now let me invite Kevin to start his presentation. Kevin, over to you.
Okay, thank you very much, Karen. The theme of this inaugural issue, as noted by Mr. Kaur, is navigating high debt in low visibility. So perhaps a picture is worth 1,000 words. So let me try to explain the theme with the picture that you can see on the screen. As shown in the picture, it's like driving on an empty road in a fog. You see the road ahead, but not too clearly. And you know the risk of a US slowdown, China property market, geopolitical risk, uncertainties about Fed policies. You don't know how this risk will unfold, although you do know that this risk exists. Worse, there could be also hidden risk, unknown, invisible stumbling block along the way. This makes the environment very challenging, particularly for policymakers, because there's a good chance for policy mistakes. And it's also hard for investors, as risk aversion could turn sour easily. So let's look at the first chart. Indeed, over the past few years, the global financial system was tested on multiple occasions. As shown in the left chart, financial conditions for US, UK, and EU clearly deteriorated due to COVID, geopolitical tensions, monetary tightening, and banking turmoil. More recently, financial conditions have eased since the banking turmoil in March this year, but hidden risk may still lurk in the background. From the right-hand side chart, we can see a noticeable decline in US banking stock indexes during the banking stress episode. Most major asset classes have regained strength recently. However, the volatility in bond markets remain elevated. The banking sector stocks are yet to recover from the sharp decline in March. The anticipated failures of some regional US banks triggered by the Federal Reserve's tightening illustrate how market might have underestimated such sudden risk and miscalculated their potential for rapid and wide-reaching spillover effect. And this is what we call the low visibility or hidden risk. Now turning to the next slide, turning back to ASEAN+3, the market condition can be further illustrated using estimate of market stress. The two charts on the screen show that market stress fell across countries after the initial impact of the pandemic, but started to rise again heading into and during the Federal Reserve's hiking cycle in 2022. More recently, market stress in the region has also eased. Meanwhile, ASEAN+3 property prices have been volatile. Generally speaking, house prices already hiked before the pandemic and surged even faster and more following the pandemic outbreak. Then they corrected during monetary tightening. Cooling house prices were more evident in China, Hong Kong, and Korea. In contrast, Singapore property prices remain resilient despite tightening in global monetary conditions. Then let us now turn to the risk. In this AFSR, we are seeing 5 major risks for the region. The first risk is that inflation may resurge. The chart shows that headline inflation has broadly been declining in 2023 as the black circles, which represent headline inflation at end 2022, are generally above the corresponding red circles, representing the latest observation in 2023 in the ASEAN+3 region. However, the pace of disinflation has been differentiated across economies, with some countries still seeing the inflation picking up recently. Some continue to see inflation above their official target, and some are facing sticky core inflation. So the key takeaway here is that resurgence in inflation cannot be ruled out. And if that happens, that will complicate the central bank's effort to safeguard financial stability while maintaining price stability. Now turn to the second risk. The second risk stems from the fact that market might not have priced in the potential hawkishness of global central banks. In the chart, the gray bar shows the end-year actual policy rate, while the red and black diamonds show respectively market expectation and Federal Reserve projection of end-year policy as of the beginning of the year. The general picture is that from 2013 to 2017, typically the market would have priced in a less hawkish Federal stance than the central bank's median projection at the beginning of the year. And the actual Fed action at the end of the year turned out to be even lower or even more dovish than both market expectation and Federal Reserve projections. But things have changed since then. More recently, just like last year, the realized policy rate at the end of the year have been much higher than both the market expectation and Federal Reserve's own projection at the beginning of the year. So as market realign to the higher for longer narrative, it can lead to increased volatilities in the market. Then let me now turn to the third risk. The third risk is that spillovers can potentially happen from the banking sector in the United States and elsewhere. In the left-hand side chart, we show that most of the ASEAN+3 financial indexes saw a limited decline after the March banking turmoil as compared with the US counterparts. And some of them have even recovered to levels stronger than before the banking turmoil. Indeed, ASEAN+3 banking system in the region appears to be more resilient to the problem that are facing the US banks. In the right chart, we see the ASEAN+3 banks generally maintain a higher proportion of fixed deposit relative to current deposit on the liability side, and a higher proportion of loans to securities on the asset side, meaning they are indeed safer than the US counterparts in both the liability and the asset. That said, the lack of recovery in the United States banking stock indexes suggests that investors are still concerned about the risk of the banking sector in the US. And since US is the biggest financial system and the biggest economy in the world, they could be easily contagion to the system. And the channel could be just simply investor sentiment rather than the direct linkages. Then let me now turn to the fourth risk, which is highlighted in our report, is the dollar liquidity squeeze. Now, if you look at the data, most headline indicator shows that US dollars onshore liquidity is quite plenty. The Federal Reserve's balance sheet has been shrinking, but it still twice the size before the pandemic. However, the US dollar funding crunch cannot be ruled out during risk-off episodes, particularly during things like geopolitical problems or weather-related or health-related incidents. And then let's now turn to the last risk, which is on the technology. Now, while technology is a blessing that can improve the financial system efficiency, it can also create new challenges for policymakers. An example is the rapid and easy transaction allowed depositors in Silicon Valley Bank to withdraw over 40 billion in a single day on March the 9th, and with an additional 100 billion expected the following day. And that had led to an immediate closure of the bank. Furthermore, new communication channel can fuel financial contagion. In particular, social media platform was significant in spreading false rumors among depositors. So with that, let me now turn to the policy implications. Now, given the low visibility environment with hidden risk that is changing and highly unpredictable, a number of key policy recommendations are in order. First, central banks should continue to focus on maintaining price stability. To this end, a strong commitment from central banks is a strong force to anchor inflation expectation already. Second, central banks should stand ready to provide liquidity when needed in such a way that would not lead to moral hazard. And third, monetary and financial stability can be compatible at the current juncture. And fourth, central banks should continue to be ready to provide temporary US dollar liquidity. And fifth, authorities need to keep up with the digital revolution and stay highly alert. And then now, let me now turn to the second part of my presentation, which has a thematic focus on the financial stability implications of higher debt. Let us begin with a chart showing the debt landscape for ASEAN+3 and other regions. Red is the public debt, gray is household debt, and green is non-financial corporate debt. And the key message is non-financial debt has steadily increased in ASEAN+3 countries since the GFC. debt levels began to surpass that of advanced economies in the mid-2010s and experienced further surge during the pandemic to the peak of 325% of GDP. In contrast to other economies, with debt falling back to pre-pandemic levels in 2022, the region still maintained debt ratios at around 300% of GDP at the end of 2022, which is significantly beyond the pre-pandemic level. The accumulation of debt is also more pronounced in the private sector, namely the household and corporate in ASEAN+3. Public debt is increasing considerably in the region as well, but broadly speaking, public debt grows at a slower pace than private debt. Within private debt, corporate debt has grown more noticeably. The corporate debt to GDP has reached approximately 140%, notably higher than the levels in Europe and in North America. Household debt has also grown rapidly, now approaching the levels of advanced economies. But of course, digging deeper, we can see a high degree of heterogeneity among economies. While some economies are pressured by high household and corporate debt, other economies may need to deal with elevated government debt. Korea and Thailand have higher public household debt. Housing mortgage generally play a big role in the accumulation of household debt. Hong Kong, China, Singapore, and Korea have higher corporate debt in the region. The debt to GDP ratios of AFSR International Financial Center are visibly higher given their financial intermediary role. In terms of government debt, Japan remains an outlier in the region. However, risk to the public debt in Japan is modest, as they are mitigated by large government assets, yen as a safe haven currency, strong external sector, and limited bond holding by the foreigners. Now let's look at the picture more closely. Let's look at the corporate debt. Now in corporate debt, the left chart shows that listed firms that are larger with greater capacity receive most of the corporate debt, and they also have a lower share of debt at risk. This is good news for financial stability perspective, as most debt goes to stronger and more financially sound firms. The right-hand side look at the impact of high interest rate on corporate. In a baseline scenario with a 100 basis point rate increase relative to the actual level at end 2022, an additional 5% of firms relative to the actual at end 2022 could face financial difficulties, defined as having an interest rate coverage ratio below 1.25. A larger rate hike of 350 basis points could stress at least an extra 5% of firms. Fortunately, a significant number of these vulnerable firms also have substantial cash reserves. So when considering the cash buffer, the share of the firm at risk only have dropped to 5%. So the bottom line of this simulation shows that corporate in the region can withstand interest rate shocks. Now let's move on to household. On household debt, the left chart shows that the estimated debt burden of selected ASEAN+3 economies, as well as simulated debt burden in a scenario with a 200 basis point increase in interest rate. The results suggest that the estimated debt burden appear manageable, even in the case of a further considerable rise in interest rate in the period ahead. At the right-hand side shows the gap between the actual house prices and the predicted house prices based on fundamentals. The result shows that house prices have declined over the past few years, and the gap between the fundamentals and the actual price have declined, meaning that there's less room for a major correction in the period ahead. Now let's look at the public debt then. On the public debt, the left chart shows that compared with other regions, ASEAN+3 has a sound debt structure that limit risk regarding interest rate, as a debt, a primary fixed rate, exchange rate as most debt are issued in local currency, and refinancing as debt remaining maturities are relatively long compared to other regions. Its share of foreign investor in public debt is also smaller than elsewhere. The right-hand side chart examines the so-called sovereign bank nexus, where the value of the government bonds held by the bank could drop because the interest rate have increased. For example, Silicon Valley Bank collapsed partly due to a sharp drop in the value of its US treasuries. Here, a stress test is conducted to look at the impact of the bond yield on bank resilience, and the results suggest that bank could maintain sufficient capital under adverse conditions. Then maybe now look at banking books more closely. On the left chart, we are simulating how a 100 basis point increase in interest rate would affect NPL. And the results suggested a 100 basis point interest rate hike could increase NPL ratio by up to 1.5 percentage point, which still mean that NPL in the region remains significantly below the levels of their peers in other regions. On the right-hand side, it shows that high interest rates are not always bad news for banks. High interest rate could also boost profitability in the ASEAN+3 bank region. This suggests the bank could pass higher rate onto borrower, thereby elevating the net interest margins if they could limit the increase in deposit rate. The key takeaway is that high interest rate may increase NPLs, and our simulations show that the end result still look fine for ASEAN+3 banking system. Moreover, the banks in the region could also benefit from higher profitability due to higher interest rate environment. And let me now turn to the non-bank financial intermediaries, the NBFIs. As shown in the left chart, ASEAN+3 is still a region dominated by banks, although NBFI have grown in prominence in recent years. In particular, as shown by the right chart, the role as NBFI of NBI as a provider of dollar liquidity has increased in ASEAN+3 and recently surpassed by banks in selected ASEAN+3 economies. Last but not least, let me now turn to policy implication. The challenging market condition have made visibility low. And to make matters worse, rapid and excessive debt accumulation by private and public sector make financial system more vulnerable. As such, important policy implications are as below. First, policy need to enhance their surveillance, regulatory, and supervisory capacity. In that regard, enhancing data collection efforts are critical. They should also deploy a wide range of macroprudential tools to mitigate systemic risk. Third, they need to take prompt and preemptive action against debt market stress. Last but not least, close collaboration among jurisdictions is also essential to mitigate the spillover risk and to work together to ensure regional financial stability. And that is my end of my presentation. Thank you very much. Back to you, Karen.
Thank you for your presentation, Kevin. You have given us plenty of food for thought. Now we will start to take your questions. When you send in your questions in the chat box, please also identify yourself and your organization. Let us start with a few advanced questions. Kevin, back to you again. What are the major risks to global financial system? And what are the major risks to the ASEAN+3 financial system?
Okay, thank you very much, Karen. So the major risk and uncertainties facing the financial markets in the region and also globally is really the uncertainties with respect to the monetary policy direction of major central banks, particularly the Federal Reserves. So inflation worry has been lower recently, but still a number of the countries are still seeing inflation going up, and many of them are seeing inflation above their inflation target. And it's not hard to see inflation can easily pick up. Just think of geopolitical tensions can easily hike commodity prices, particularly oil price. And just think about something like a health or weather related that can also increase inflation, supply constraints, supply chain, etc. So all these things meaning that inflation can pick up anytime. And in that case, the Federal Reserve and other central banks could easily hike and make the financial condition tighten. So that is a very important risk. And then the second risk is the banking system concern, particularly in the US. And in the presentation, I showed that the ASEAN+3 banking system are quite sound, but that does not mean that they will not have spillover from the rest of the world, particularly in US. Now, in the US, the banking system, one of the major problems is that a lot of the banks are exposed to the commercial real estate sector, which have been hard hit by the pandemic because people are now open the Pandora box of working from home, and they don't need to have the commercial real estate. So, and in addition to that, some middle and small size banks are also facing increasing competition from MBFIs, and they see their net income shrinking. So that also limit that. So this could, if this thing happened, you can easily spill back to Asia. And then the last risk that I can think of is the dollar financing squeeze. That can happen anytime because the region rely the US dollar to conduct business and financial transactions, and any geopolitical or any risk off sentiment can easily squeeze the dollar funding prospect. And of course, there are other things that I mentioned, such as digitalization threat, geopolitical, those things would clearly be in the background that could haunt us easily.
Thank you, Kevin. Now for the next question. Regional currencies have been under pressure lately. How long will this continue? And what are the key factors that will affect ASEAN+3 currencies in the next 12 months? Over to you, Dr. Cole.
Thank you, Karen. So indeed, regional currencies have been under depreciating and under pressure. But if you look at the currencies, they are all depreciating together, and so it means that the underlying problem is not the regional currency, but the US dollar being very strong. And the US dollar is strong because of high interest rate and expectation that that the Fed may raise interest rate again. So the weak currency in the region does not reflect on the fundamentals of the economies. In fact, the fundamentals are pretty sound. So I would say that this is a cyclical phenomenon, and that the currencies will begin to turn around and appreciate once the US interest rate begins to weaken, and that would take place, when the Fed decides that inflation is under control and they are able to ease interest rate. Already we see, in the last few weeks that regional currencies have started appreciating again, and the US Federal, the US interest rate, both especially in the 10-year and the medium 10-year, has started to weaken.
Thank you, Dr. Kaur. Kevin, do you have anything else to add to this question?
Yes. So basically, I concur everything that Dr. Kaur mentioned. In addition to that, I think one of the factor that could affect the currency is really about the risk sentiment. So usually, typically during a risk-off period, a lot of money will flow back to the United States, make the US dollar stronger, then make the currency weaker. And the other factor is geopolitical risk that I mentioned earlier. That sometimes when you have geopolitical risk, you can also raise the commodity prices. And then when commodity prices increase, that would appreciate the commodity exporters of the region, but would depreciate the commodity importers of the region. So there's other factors that may be also important.
Thank you, Dr. Kaur and Kevin. Moving on to the next question. How do you see the impact of geopolitical developments on the financial stability of the region? Dr. Kaur, would you like to take this question?
Yeah, sure. So geopolitical development has a big effect on financial stability. It depends on the nature of the geopolitical development. If it is a conflict, as in the war in Ukraine or Middle East, it's likely to lead to risk aversion, possibly disruption in supply chain, and higher commodity prices. So this would mean that, and that's what we saw a year ago, spike up in inflation globally as well as in the US, and which will cause the Fed and the major central bank to raise interest rate. So that's one effect of a geopolitical development, which is quite adverse. The other is, of course, the conflict between countries, over economic or trade policies. And we saw that when Trump, imposed tariff on China. So that's likely to lead to trade diversion. But that's relatively benign in the sense that even though there's trade diversion, the global trade volume will not be affected that much. So we saw, for instance, in the case of trade between China and US, that China's export to the US will be affected, but then China's import, the US will import from other countries in the region. So overall, China's trade with US may go down, but its trade with the other regions will go up, and the other regions trade with the US will go up. So that's another effect of geopolitical development, which is mostly on the trade and economic side, which is quite benign. But it can escalate to a conflict like what we have seen recently between the US and China, where they impose sanctions on export of cheap semiconductor, high-end semiconductor, and also equipment to China. Again, that can be fairly contained, and China is developing its own, semiconductor as well, high-end semiconductor. But this can escalate further and become, lead to a bifurcation of the technology space, and also cause disruption in trade and investment if we continue to escalate. This would be much more serious because it would mean that country may have a choice between siding with the US or siding with China. And I think the IMF has done some simulation where it shows that the loss in GDP can be quite substantial. So we hope that geopolitical development doesn't evolve in that direction. And then there's a positive geopolitical development where countries come together to solve global problems, as in climate change. And also, for instance, the debt problem that many countries have. They need a global solution because the debt is owed to so many countries. But I think the most important is the climate change in particular, where you need many countries to take mitigation measures to reduce the carbon emission. So if countries come together and work together, then I think that would help to globally to solve the problem. And within the region, we also see that countries can come together to set up, for instance, AMRO and CMIM to help solve a regional problem. The vulnerability of countries in the region to volatility shocks, for instance. So by setting up the pooling reserve and setting up the CMIM, they are able to address that vulnerability. And also AMRO is able to provide surveillance. So these are all the different types of geopolitical developments that can affect the region, depending on the nature of the geopolitical development. Let me stop here.
Thank you for your insights, Dr. Kaur. Kevin, the next question is for you, and it reads, what are the risks to US dollar funding that you see in the region?
Okay, thank you very much, Karen. So as I mentioned in the presentation, US dollar remains very important in the ASEAN+3, actually the whole global international financial system, as most of the financial transactions are still conducted in US dollar. So then now we see some structural issues that make dollar funding squeeze more likely, and there's two things. And one is that on the supply side of the US dollar has declined as the US Federal Reserve has begun their quantitative tightening, rate hikes, and shrinking their balance sheet. That make the supply of liquidity of dollar has declined. And then the second is the demand side. The US debt ceiling has been increased repeatedly, and so debt issuance would increase. So that would also compete for the US dollar as well. So typically, there is a dollar squeeze when there is a risk off sentiment because investors may be holding the US dollar. And because of this structural issue, it makes it more likely. And in the past, we see that the dollar funding squeeze happened during geopolitical crisis or some pandemic issues and also banking turmoil. But sometimes it could be just driven by purely technical factors, such as like algo trading hitting certain kind of technical benchmark and threshold, and that caused the dollar squeeze in some overnight in some trading overnight sessions and things like that, and then you see the spike in the cross currency swaps, etc. And these things is something that is going to be more likely, considering the fact that the supply and demand is going to be more tightened going forward. And with that, maybe I don't know whether Prasad have anything to add from market participant perspective.
Sure. So a couple of points. The first is normally these dollar funding stress episodes tend to be more severe and longer for the global markets. US markets, typically Fed would step in and resolve the issues. But as we have seen during the pandemic and also in 2021, there can be instances where the global market faces more of these issues, and that's where ASEAN+3 region may also be impacted. The other observation, and this is something that we learned from various market participants, is that non-US banks which have businesses in different jurisdictions, they are the ones who are more vulnerable to dollar funding stress. In the region, we have large banks which operate in the cross-border settings, and that's where they may face some issues if a dollar funding stress emerges. Yep, thank you. Back to Karen.
Thank you, Kevin and Prashant. Let's move on to the next question, which is from April of Barron's. She asked, what will be the main driving force of China's growth next year? And what is unique about China's economic structure and growth path compared to Japan and Korea? Dr. Kaur, I believe this question is for you.
Thank you. China is gone through a rough patch this year. The economy has been in a bit of a roller coaster. It bounced back very rapidly in the first quarter, then it weakened in the second quarter, and the third quarter seems to be recovering again. So looking ahead, we expect growth to continue to recover, led by basically domestic demand, especially consumption. We see that already in the retail sales indicator, which is picking up. And also, when you look at investment, although real estate investment is weak, it is sort of flattened off. But we see pretty strong growth in manufacturing investment and infrastructure investment. So domestic demand will be an important driver of growth next year. On top of that, the external headwind from weak export is subsiding or diminishing. And we've seen that in terms of the export pickup in countries in the region like Korea, Japan, and also in China. So these are the different drivers of growth for China next year. We expect that the real estate sector will take a bit longer to work out, but the rest of the economy seems to be holding up well, and that should be able to boost the economy, drive the economy by slightly over 5% next year. The other question is what is unique about China's economic structure and growth? China's economy is massive. On the PPP standard, it's the largest economy in the world. It's second to the US in the market exchange rate. And because of the size of the economy, it's less dependent on the external demand, unlike most of the other countries in the region. So we saw that this year, and actually from the second half of last year, when export began to weaken very sharply, and many of the economies in the region, because they are very highly dependent on manufacturing export, weakened along with that. And whereas in the case of China, it's much more driven by domestic demand, and it held up pretty well. The main factors affecting China's growth was because of domestic factors like the COVID policy. So for that reason, China was also relatively less affected by, for instance, the spike up in commodity prices. Inflation remained pretty subdued last year and this year. So because of that, China is an important driver of growth for the whole region, not just in terms of its own economy. So when China begins to recover, it also helps to pull along the rest of the region. And right now, for instance, we see a lot of a boost from tourism because of the opening up of China's border and the recovery of Chinese tourism to the region. Let me stop here. Thank you.
We have time for one last question because we need to get back to the AMRO forum that is taking place now. This comes from Ruoxue of Business Times. She asked, your press release states that debt levels in ASEAN+3 reached 300% of the region's GDP at end 2022. Does it refer to the total debt accumulated by businesses, households, and governments of the ASEAN+3 economies? And how does this figure compare to other years? Kevin, would you like to answer this?
Okay, thank you very much. Yes, let me confirm that the data is indeed correct. Total debt in the ASEAN+3 economies were at around 300% of GDP as of end 2022. And that is a total debt, including household, corporate, and government debt, non-financial debt. And the number compared to before, the number has actually gradually increased from about 230% of GDP over like the past 15 years. So there's quite a significant increase. And more specifically, it peaked at about 325% in 2020. That is not only because of a sharp rise in debt, but also weaker GDP growth during the pandemic. But since then, the debt to GDP has eased a bit because the GDP growth has also picked up as well. So indeed, the number is correct.
Thank you, Dr. Ko, Kevin, and Prashant for your insights today. We have now come to the end of today's press conference. Thank you for joining us. If we missed your questions or if you require more information, please email us at media@amro-asia.org. You can visit the AMRO website to download the report, press release, and today's PowerPoint presentation. See you at session 2 of the AMRO Forum, which is starting now. There will be a panel discussion on the implications of soaring debt and financial stress on ASEAN+3's financial stability. Thank you for joining us and hope to see you soon.
Thank you.
Thank you.